Hello everyone, welcome to Just Invest Today. And today I have a good video for you guys. Today we're going to be talking about a stock called Five Below. Is this the best stock to buy in 2021 and on? So when we're buying stocks, we are looking for the future potential. And I believe this company has a bright future. And in this video, we're going to get into it, see what this company is about, and see if we should buy this company now or we should wait for a better investment opportunity, or should we just move on? So let's get into this video, guys. If you like this video, just like it and subscribe. I'm going to be providing a lot of good content, a lot of value, and tell me what you think about the stock. Before we invest in any company, we got to make sure it checks off these four categories. Do we understand the business? Is it in our circle of competence? And that just means that we can actually look at the business, understand what it does, and how it makes its money. Number two, does this company have a moat? And when I talk about a moat, I want to talk about a company with a competitive advantage. And it has to be a durable competitive advantage. Something where in 5 and 10 years, it's still going to be the same company. It's still going to be hard for competition to kind of get in and infiltrate what your moat is and what you're doing with the company. So it's just solid. You can depend on the company. Third thing, we need a good management team. We want the management team to do what we want it to do, basically. We want it to have the exact same values as us. It's heading in this right direction. The right direction is the direction that we want to see this company going into the future. So that has to be in alignment. And then the last thing we want is a good price to pay. And when we're looking at a good price to pay, we have to make sure that the value that we're paying today is below the price that's on the stock market and what's it selling on the market. Because when we're paying for these overpriced companies, especially in today's market, your returns are not going to be as high. So we still want to look for a good company, but the price has to be right. If the price is not right, we still have to wait. We got to wait for that price drop. So in this video, we're going to see if this company is in our buy range or we have to wait until this price drops. So Five Below is a value retail store offering trend-right, high-quality merchandise products, offerings that are geared toward teens and tweens, customers at $5 and below. Five Below is a high-energy retail store customer experience, allowing customers to let go and have fun. So this company is very targeted to a direct niche market, and when it's doing this, it's capturing a nice, solid market that other competitors are not really doing. A lot of competitors like Donald General, they're just more everywhere. They're just more of everyone can get the product, everyone can get it, it sells to everywhere. But this company is very more direct and direct selling and is very customer focused. And this is pretty good because then actually it can hit the parents too, because we already know teens and tweens have a lot of like disposable money, and especially with their parents too. Their parents are willing to actually give their kids money and actually pay for these products because they provide good value at a good price. Five Below. So Five Below is actually starting to creep up. Their prices and their products are actually kind of creeping up in price. Usually the company sells Five and below, but they're seeing even demand in the 10 and up. So $10 and up, and it's even creeping towards the $15 range. So this can be seen as a very good thing. The price of the products are expanding and the money they're getting from each basket is expanding as well. What is so amazing about this business is that it acts as a treasury hunt type of business, which is proven to be very resilient in an online economy. People actually want to go to the store because it's a treasury hunt, see what they can find, see if they can find something new. So people are excited to go and explore and see what they need to find instead of just actually just going on Amazon. You just have something specific in your mind and you go get that product. But in Five Below stores, you can actually just go around, explore, see what you want, and then get a lot of products. And that's a good concept to have because it's going to make sure demand in the retail store is going to stay strong. So as you can see, Five Below is very simple to understand, and we can kind of see that these businesses that are very simple are not going to have these wild variations, and we can kind of predict where it's going to go because The dollar scene isn't gonna go away. It's not gonna get obsolete. And especially in times like this, people are looking for value. They're not looking to buy expensive stuff, as a lot of US jobs are actually declining still. So these companies are going to survive these kind of events, and then they're going to benefit for it in the future. So Five Below has 7 categories. They have style, room, sports, tech, crate, party, and now. And in each of these categories, they sell a specific type of product, and they like to put this in the merchandise in the store depending on what kind of product it is. So when we look at style, it consists primarily of accessories with novelty socks, sunglasses, jewelry, scarves, gloves, hair, accessories, athletic tops, bottoms. In the category of room, cosmetic of items used to complete and personalize our customer living space, including glitter, lamps, posters, frames, fleece, blankets. Sports consists of assortments of sports, balls, team sports, merchandise, fitness accessories, including hand weights, jump ropes, all of that, guys. Then they have tech, consists of selection of accessories from cell phones, tablets, audio, computers. Crate, another solid category. They offer an assortment of craft activities, kits, arts and crafts, supplies, crayons, markers, stickers. It offers candies, consists of branded items and apparel of tweens and teens. Includes a lot of like movie size candy bars, seasonal related candy items, gum, snacks, all of that. And then it has now, which is actually seasonality stuff. So it has specific items used to celebrate and decorate events such as Christmas, Easter, Halloween, St. Patrick's Day products. So guys, now we move on to moat. What's its competitive advantage? And when we're doing this, we want to find the qualitative stuff and then the quantitative stuff. So the qualitative stuff is like what you find, what you think this company's moat is. And when I look at this company, I think the very strong moat of this company is that it has a strong price. And the price of this company gives it a competitive advantage. The products are usually 5 and below, which offers high value to customers, especially because look at it, they're actually targeting a specific demo, the tweens and teens. They're not going to be spending a lot of money. So they're going to be actually seeing that 5 and below, and then they're going to want to buy a lot. And then when the parents see that discount too, they're going to help buy a lot too with the kids. So when we're looking at that, you can see that the price is a good value, which gives it a competitive advantage, and it's targeting a specific segment of the market. So when we get the qualitative down, the qualitative has to match the quantitative stuff. So when we're looking at the quantitative stuff, we want to see strong growth rates, consistent growth rates, and strong growth rates in the company. So I'm looking at the 5-year averages and then the 1-year averages, but during this time, I didn't look at the 1-year averages because we know what happened. Businesses were shut down and stuff. So I look at the 5-year stuff to see what this business was doing. And when you look at the 5-year stuff, it's amazing what you see with this strong company. The revenue has been growing at 21% year over year. The EPS growth rate at 29%. The book value has been growing around 15% year over year. And the cash has been growing at around 15 to 20% year over year. So when we're looking at that, we can see that this company is very strong according to the numbers. So it backs up our qualitative perspective on this company. And that's what we love to see. We love to see companies growing more than 15% year over year. 15% and above, that's what we're looking for. Those are strong companies that we can see out in the future. And when it's been doing that for a long time, that's how we know this company can be very strong growing into the future. So from the third quarter of 2020, it had 1,000 stores, and it's been growing very fast. They've been opening up 100 stores at least per year, sometimes more, and that's growing and growing, and everything is just happening so fast. They're able to pay off their stores around 7 to 8 months of just free cash flow. They don't even have debt to pay off these stores. They're just using the money that they're making in the store and from its products just to pay off all the new stores are opening. And that's a strong business. When we can see that happening, we can see management going in that direction. So now we can go to management. When we're looking at management, we want to see what the CEO says. If the CEO is backing up its words that it's presenting to the public, that it's writing about. And then we want to look at return on equity and return on capital. These are strong metrics to see how the business is standing, how the business is allocating capital, is it efficient, and is it providing value to the shareholders, us. So the CEO, Joel Anderson, placed a 2020 through 2020 strategy in 2016, targeting 20% top line and 20% bottom line growth annually through 2020. And in 3 years into that, he hasn't missed a single year. That just shows you how strong his vision is, how much he's putting out there, and he's actually cashing in what he's saying. So we can see that with what the company is doing and what the company is presenting. So that's a good sign when it comes to management. And you can see the expertise. This company has no debt. So he knows what he's doing. He's actually very efficient when he's opening up these stores. He's paying them off in 7 to 8 months with its money. And that shows integrity. That shows what he is capable of is doing his job. And when we look at return on equity, return on capital, it's above the demand. It's above the 50% target we're looking at. And they do this consistently. There's no hiccups in this. So they average 50% and higher year over year for 5 to 10 years. And they've been doing that with both numbers, ROE and a return on invested capital. When I did my margin of safety analysis on the company, I got a fair value. If we project this company to grow 20% year over year into the future, I have a fair value around $191. And the company right now is selling at 180. So that's not a great discount. And remember, we want to buy with at least a little bit of margin of safety because we don't know for sure if it's going to be able to grow 20% into the future. And specifically during these times, it's going to be hard. Maybe in the future, we don't know, to grow 20% year over year. So I want to be more conservative and put a 70% growth rate on this company. And if I put a 70% growth rate on this company, the fair value is around $118. So that's what I'm kind of looking for to buy into this company. I want to see around 118. And if it's 118, I will pounce on this company. I will buy a lot of shares because I really believe in the management. I really believe in the company. So we're going to see what happens in the future. Maybe we see a downturn in the market, but I'm going to have this on my watch list. For me right now, I don't think it's a buy because it's almost at its fair value already, but I'm going to have this on my watch list. I'm going to be waiting to see if this company goes down. But if it never goes down, it's okay. We move on to the next company. And that's what we do as investors. We move on, we find another company that kind of fits our range or fits our price targets. So guys, if you like this video, can you please like it, subscribe to my channel, and I'll get back to you in the next video. Peace.